Most people think Bitcoin's next big move will come from a headline, a rate cut, a crisis, a new ETF approval. But what if the real decision about Bitcoin's 2026 price cycle has already been made? Quietly, in a rulebook almost no one reads. Because Bitcoin doesn't crash anymore the way it used to, and it doesn't explode the same way either. That's not an accident, it's a system change, and once you see it, you can't unsee it. To understand why this matters right now, you have to forget the stories people usually tell about Bitcoin cycles. For years, Bitcoin felt wild because it was wild. Loose leverage, retail-driven demand, minimal oversight, price discovery driven by emotion, not structure. When momentum started, nothing stopped it. When panic hit, nothing caught it. That chaos created legendary cycles. But Bitcoin isn't trading in that world anymore. It graduated. The turning point wasn't a crash, it wasn't a ban, it wasn't even the halving. It was integration. Bitcoin moved from the edges of finance into its core systems. ETFs, cleared futures, institutional custody, balance sheet exposure. That sounds bullish, and it is, but it came with a price most people didn't notice: rules. Here's the key shift. Bitcoin's price is no longer set mainly by people buying and selling the asset itself. It's increasingly set by derivatives tied to it: futures, options, ETF creation and redemption flows. And derivatives don't run on belief, they run on margin. Margin is the hidden engine behind every explosive move Bitcoin has ever made. When margin is cheap, leverage expands. When margin tightens, leverage disappears. And leverage is what turns demand into parabolic price action. Now here's where the quiet rule change enters. Over the last few years, regulators and clearinghouses adjusted how volatile assets are treated inside risk systems, not just crypto, anything that moves fast and unpredictably. Bitcoin sits at the top of that list. Instead of fixed margin requirements, Bitcoin exposure increasingly falls under dynamic margin models. Simple translation: the more Bitcoin moves, the more collateral traders must post. Volatility itself becomes a penalty. That creates a strange new reality. In the past, Bitcoin's volatility fueled bull markets. Now it triggers risk controls. When price rises too fast, margin requirements rise automatically. That forces traders to reduce exposure. Buying pressure turns into selling pressure, not because sentiment changed, but because math said so. The market doesn't panic, it complies. This is why cycles are starting to feel different. Instead of blow-off tops, you get ceilings. Instead of violent crashes, you get slow compressions. Price doesn't collapse, it stalls. And stalling is far more confusing than crashing. Now add institutional behavior into the mix. Institutions don't chase price, they rebalance exposure. They have volatility limits, position caps, correlation thresholds. When Bitcoin rises sharply, they trim. When it falls, they wait. Not because they're bearish, because their mandates demand it. This behavior quietly absorbs momentum. By 2026, most Bitcoin capital will flow through regulated wrappers. That matters more than supply, because supply shocks only work if buyers are free to respond, and today's buyers are constrained. The uncomfortable math is this: small increases in margin requirements can reduce effective buying power by 20 to 40%. That doesn't show up as bad news, it shows up as missing price action. The rally that never quite arrives, the breakout that fails without drama. This is where hype and reality collide. The narrative says post-halving scarcity guarantees explosive upside. The structure says upside is capped by risk models. Both can be true, but only one sets the timing. Zoom even further out and the pattern becomes familiar. Every asset that matures goes through this phase. Gold did, oil did, equities did. Integration brings liquidity. Liquidity brings stability. Stability brings rules. Bitcoin is just compressing that journey into a decade. Here's the quiet irony. The same rules that make Bitcoin acceptable to institutions are the same rules that may flatten its cycles. No bans, no crackdowns, just formulas quietly doing their job. And formulas don't care about narratives. So what does this mean for the 2026 cycle? It may not end with euphoria. It may not end with fear. It may end with boredom. A slow grind higher, then sideways, then lower. No emotional climax, no clear signal. And that might be the most dangerous environment of all. Because people won't know when the cycle ends. They'll only realize it did months later. The real question isn't whether Bitcoin will go up or down in 2026. The real question is this. If Bitcoin cycles are now decided by invisible rules instead of visible hype, how do you recognize the cycle while you're still inside it? Because this time, nothing will break. Nothing will fail. The system will work exactly as designed.